Amid rising interest rates, Singapore Treasury bills hit a peak cut-off yield of 4.4% late last year. But since then, yields have fallen. T-bills and SGS bonds are securities that are issued and fully backed by the Singapore government. T-bills have a short maturity period of 6 or 12 months, compared to SGS bonds, which pay a fixed interest rate with maturities between 2 and 50 years.
10 years ago, a T-bill would probably give you 1% or less. Last year, it gives you about 4% at one point in time, and now it gives you about 3.7%. So you can see there's a very big jump in the interest rate, and that's what got a lot of investors interested to shift their savings into T-bills because they can get higher returns. The Treasury bills are yielding higher than the SGS bonds, which are longer term in tenure, 2 years and above. So for these T-bills, right, they have 6 months to 1 year maturity, and their yields are about 3.7%, while the longer term bonds are about 3.3%. So that means that investors see that, hey, I can get more money buying these short-term T-bills than compared to the SGS bonds. But we must also take note that because they expire pretty fast, like 6 months to a year, and you will need to buy a new batch of T-bills to replace the one that's maturing. And there isn't a guarantee that the interest rate will stay the same, like next year when it matures.
SGS bond and T-bill interest rates are now more competitive than that of fixed deposits, as well as the CPF ordinary account, offering investors the opportunity to be rewarded with higher yields if they're prepared to commit their funds for the full duration of the tenure.
Because the CPF ordinary account is paying about 2.5% at the moment, and the SGS bond is paying more than 3% per year. So there is an arbitrage opportunity where you can use the CPF money to invest in these SGS bonds to increase your CPF interest rates. So that would, of course, increase your pot of gold at the end of your retirement. It is only possible now because of the interest rate environment. We have never seen this in the last 10 years, right? Except this year, we started to see the longer term bond yield has climbed up, and people may want to take advantage of this situation because it may not last. If the interest rate gets cut in, say, the next few years, this phenomenon of having your SGS bond yielding higher than your CPF OA will disappear. So it might be a timely situation to look at this.
An interesting thing to note is that if you are looking at non-promotional rates for fixed deposits, you might find that some of these risk-free products like T-bills and SGS bonds might actually be quite attractive. The returns might be slightly higher. So this is why we have seen a lot of people investments and keep reinvesting money that they have had from matured T-bills in the last year.
For the uninitiated, analysts say Singapore savings bonds are a good place to start. With a minimum investment of 500 Singapore dollars, it is capital guaranteed, and investors may redeem early with accrued interest and no penalty.
If you're a first-time investor and you are very unfamiliar with how investing works, or you have a lot of fear about starting, I would say you can look into Singapore savings bonds first because of the way they are structured. They have a step-up interest. You might be able to build confidence along the way with investing. And if you do need funds for emergency uses, you are able to liquidate those investments relatively quickly.
One aspect of this SSB is that the bond price doesn't fluctuate. It will stay at the par value from day one all the way until maturity. So even if in between the years you decided to liquidate it, you will still get back your principal. And the other aspect of SSB is that there's this escalating interest, which means the longer you hold, your interest actually goes up.
Anyone above the age of 18 can apply for Singapore Government Securities. All you need is a bank account with one of the 3 local banks, DBS, OCBC or UOB, as well as an individual CDP or central depository account. Application can be done via your mobile. You can use any of the big 3 local banks apps, but for this demo, we're using the POSB Digibank app. Once logged in, tap on Invest, followed by SGS. This will show you the various SGS instruments. Currently, there's Singapore Savings Bonds, or SSB, and SGS bonds that are available. The closing date for both is the 26th of September 2023. SGS instruments are relatively safe investment options, but there are still risks, including the risk of being too safe.
If interest rate go up further, the bond prices may fall. You are fine if you hold it to maturity because you get back your principal. The only problem comes when you sell the bonds before the maturity, which means you need to take the market price at that point in time. So if the interest rate goes up, bond prices fall, you will incur a loss selling the bond. So that is the, I would say, the key risk when it comes to SGS bonds.
If you are building your 30 years retirement plan and you want to make sure that money works for you in a certain way, you should have a portfolio that is not 100% lowest risk possible, which is not 100% only government bonds. The markets over the next 30 years will have some ups and downs, and they will. It's not a problem because you can wait. Your goal is longer. And so to maximize that 30-year return, you should actually take some additional risk than you will do on a 2-3 years goal. And so there is a risk of not taking enough risk for your long-term goals. And the risk is that when you retire, you actually have less money than you wish you had.